Big Brain Investors, welcome back to the channel where we cover investment strategy and the latest market news. My name is Nate and I will be your host for this video. Today we're going to be talking about long-term versus short-term investing. Investing can be an overwhelming endeavor. Educating yourself on the different methods can be the difference between success and failure. You will be glad you clicked on this video and took the time to learn the pros and cons between long-term and short-term investing. But for this video, we're going to be focused on the stock market and not really look at other things like trading coins and stamps and real estate. Let's start with short-term investing. First of all, what is short-term investing? The government evaluates short-term investing as 1 year or less in any position. Investors typically buy these assets because they expect profitable movement within that time period. That time period could be as short as seconds. Short-term trades are typically done with options and stocks. The pros with short-term investing. First off, your money is not tied up for very long. You can typically get in, catch the movement, and hopefully make a profit and get out. This allows you to quickly jump into another trade. Second, if you're good at it, it can be highly profitable. This is how the ETFs are traded by bots. They make lots and lots of little trades for a little bit of profit. The cons to short-term trading. Undoubtedly, the biggest con to short-term investing is the increase in taxes. Simply put, depending on the tax bracket, you pay about double on short-term gains as you do long-term gains when it comes to taxes. This is a huge impact on profitability. Typically, the successful short-term traders do not invest more than 2 to 5% of their portfolio in any one trade. This helps negate the losses, but it also means you need to research many more trades, which can take a lot of time. Short-term trading can be highly emotional because you're constantly looking at the stocks and reviewing it and seeing your bottom line every day. It's really easy to get emotionally wrapped up in the trades and letting it affect you. So feeling frustrated when your analysis was incorrect or scared because it falls past a certain point, you can even get angry because it goes so low and it's past your limit, so you sell to get out to mitigate your losses, and then the very next day it pops up and becomes profitable, or it would have been profitable had you stayed in. And you see those things and it just drives you crazy. When your emotions are too overwhelmed like that, you start making bad trades. Usually this ends up looking up like the trader starts using the stock market like a casino rather than a money-making machine. And it goes downhill from there. They think, well, I lost on my last one. I'm just going to double down on this trade. And, oh, I lost on that one too. Can't go wrong on this one. And then, that one goes wrong and they start to feel super frustrated. And those things happen. There's reasons why the short-term traders have rules, and not getting emotion involved in your trades is one of them. Another thing is it takes a long time to master. When you're doing short-term trading, you need to look at all kinds of indicators and you got to follow the news. You're looking at averages over 90 days and 120 days, and then you're looking at trend lines and Fibonacci circles and all these different things, and you have to know a lot about that, and it can be daunting. And there's part of you that realizes that you're competing against trained AI algorithms in hopes of beating them and making a profit. Next thing is short-term trades are often vulnerable to volatility in the market. So every now and again, there can be an event called a black swan where the entire market just dives off the deep end. And this can destroy all your options that you might have in a bullish position, or even your stocks you bought and you're waiting to resell again. That could cause you to commit for a long period of time unless you want to just get out of that trade and invest to buy other stocks. But either way, the volatility here can just wreck short-term trading. Whereas a long-term trader, they'll look at that and they'll be like, oh, the market will recover. If you look at the time the pandemic occurred, the stock market took a dive bomb and it took several months to recover, but the long-term traders weren't really affected by that. So that about sums up the major pros and cons for short-term investing. Let's take a look at the long-term investing strategy. So long-term investing is holding a position in the stock market for over a year. It can go as long as you like, and it's really not uncommon for people to hold position for decades. Usually this is done with stocks, but it can also be done in options that go over a year as well. But the vast majority of options are going to be less than a year. So the pros with long-term investing. First, contrary to short-term investing, the taxes are good. You can pay as little as 0%, but you will usually pay around 15%. All depends on your income bracket. Next, it requires relatively little research compared to short-term investing. You don't need to worry about the chart indicators or what is currently happening in the news. You invest because you believe in the company and you believe it'll make money. Usually this is because they have a proven track record and they have some disruptive technology coming out, like a company like Tesla. You could utilize, you can also utilize accounts like the 401ks or the Roth IRAs. These accounts have additional tax advantages you can utilize. You'll have to see your certified financial advisor for detail on that. Next, we have long-term investing is far less likely to emotionally trigger you. The main reason for this is you're not looking at the stocks every day. So when they go down, you might not even notice that they go down. Or if they go up a little bit and you don't notice, you're not even tempted to sell because, again, you're not watching it every day. You just know that you plan on selling in several years in the future, so you don't even need to babysit it, other than checking on it, I don't know, once a month or every few months. You might come back and look at it just to make sure that stock isn't completely tanking and you have to reevaluate. But when the stock goes down, you see it more like it's on sale and you want to buy it while it's on sale rather than, oh no, the stock's falling and I've got to get out and mitigate my losses. You're not worried about that because, again, you're in for the long term, at least a year or a decade or two. So again, you'll have faith in the company and you know that the average stock usually tends to go up. And as long as the company isn't tanking and they don't have some serious issues going on, you're going to stay in. So let's cover the cons on long-term investing. The biggest con is that your money can be tied up for a long time, meaning you can't really utilize it with the exception of borrowing against it, which I highly recommend you don't do. And the second con is if your research is bad or the company suffers from an event they can't recover from, like this, I don't know, like Tesla would have a huge issue if Elon died or something like that. They might not be able to recover. However, this is really just a known risk when using the stock in any type of fashion. You just know that stocks might have that risk and it could happen. That's why, again, you do your research at first and if that happens, it happens, but it's pretty uncommon for that to just happen to a great company out of nowhere. And the last con is it takes discipline to not only have that original investment you put into that company, but to continue to invest in it over the years. So oftentimes we'll have like some cash we can invest, but it's that continual depositing and the regular building up of our position that really causes those long-term investments to really pay off in the end. And obviously, the more you front load those investments, the more it's going to pay out. But if you can only do 500 every couple months, then that's what you do. So in the end, my preferred method is long-term investing. So I find it less stressful and it's probably more profitable for me because it is less stressful and I don't have to be so emotionally involved in it. So here's a couple examples, well, a few examples of long-term investing that historically have done well in the last 20 years. So if you spent $10,000 on the following stocks, this is what would have happened. If you'd bought Apple in December of 2002, it would have been 25 cents a share, and you would have had about 40,000 shares. Today's value for that would be $5 million. Not bad, right? If you'd bought Google in December of 2004 at $90 a share, you'd have 111 shares. Today's value for that, still $228,000. That's not too bad. If you bought Netflix in December of 2002 at 75 cents a share, you'd end up with 13,333 shares about, which would equal out today to be about $7 million. Okay, and I had to throw this in there. This is basically the best example I have. If you had bought Monster Energy drink in March of 2001 for 7 cents a share, you'd have 142,000 shares. And today's value for that would be $12 million. Now you just bought it then for $10,000 and you just buy the stock and you leave it alone for 20 years. And it sits there and it grows and it does well. Yeah, so some of those numbers are cherry picked. That's fine. But it isn't unreasonable to see a 10 times gain over 20 years. If you do a little bit of research, this is far better than even the S&P average returns of 8% a year, which would give you about $45,000 for your initial $10K invested over 20 years. Ultimately, it's really your choice to decide what method works for you. Leave a comment below. Let me know your preferred style and why. Or let me know if I missed any pros or cons that I should have mentioned. If you enjoyed this video or you think other people need to know about this information, then like and subscribe to this video and hit the notification icon. Just hitting that like button can be your way of making the world a better place. Until next time, have a wonderful day, and I will see you soon.